I'm Brian Beaulieu. Thank you for joining me for this edition of ITR Economics FedWatch. Today is November 17th, 2023. And there are four things I would like to cover today. One is the encouraging CPI report that was released this week through October, not just for October. And you've read all the numbers, I'm sure, in different media outlets, but I wanted to make sure you noticed or you saw someplace along the line that the month-to-month index, the overall consumer price index, declined in October. And usually 1 month isn't a big deal, but when it declines in October, and I went back and looked, it is indicative of weakening economic conditions. And I'm sure the Fed has their own economists that can look at such things. But it doesn't happen when your economy is fundamentally healthy or booming. It just doesn't work that way. So it's just one of those tells that we noticed in the CPI data. The core CPI was down to 4.0%, which is the lowest we've seen since September 2021. And looking at what the Fed really cares about, which is the personal consumption expenditures price index without food and energy, that was down to 3.7%, which is a nice improvement. In May of this year, not that long ago, 5 months ago, it was at 4.7%. And it's coming down nicely from our perspective from the February 2022 high of 5.6%. So we're seeing movement in the right direction on these interest rates. There's enough here to give the Federal Reserve reason to pause in December and change their minds about 2024. Second thing I wanted to touch base with you about was we're already seeing the impact of these higher interest rates. That started happening in the third quarter. You may recall in many of our writings and in our keynotes, we've been saying the full impact of these rising higher interest rates. We haven't really begun to move into that territory yet. The third quarter data made it pretty clear that these higher interest rates are indeed taking a bite out of capital expenditures, new orders, manufacturing activity, all of which total industrial production tied back into these high interest rates. And if you watch our ITR trends report, you see it come up on your phone when we released the U.S. total industrial production analysis. You'll see that the 12-month moving average for industrial activity in the United States has declined for 2 consecutive months, which means we have some negative 112 and now 312 rates change. And that the updated analysis done by Jackie Green shows that August tentative high is very likely going to hold. Manufacturing's in decline and overall industrial production is slipping as well. And it ties right back to these higher interest rates most directly. So we're seeing that the interest rates are having their intended effect, probably not as quick as the Federal Reserve wanted it to be, but it doesn't always work that way. Third point I wanted to talk to you about was we've reached an interesting inflection point in the money supply. Money supply M2 we use deflated is down 7.1% from 1 year ago. It's the 112 rate of change. The 12 rate of change is at 7.2% negative. So we have the 112 is up for just 1 month. So we're not even seeing any significant breaking action in the declining trend in the money supply. And what's remarkable about that is, and what we're going to keep a key eye on, is that we're at the point now in the money supply trend where they have sanitized all the money that they had pumped in there through COVID. If you look at the pre-COVID trend in the money supply, we're back to where we would have been without them throwing all this money into the economy. And what that means is from this month forward, with ongoing descent in the money supply, it really begins to bite further and further into the overall economy's liquidity. It means that the Federal Reserve's restrictive policies are that much more aggressive since they've now neutralized the upside. Now they're just creating more drag on the economy. They should start seeing what they want to see in terms of inflation coming down more rapidly now that we're going through that particular threshold. And the fourth point I want to cover is that we're at a point where the inverse yield curve exists for about 106 basis points. In other words, we need short-term rates to come down 106 bips in order for the inverse yield curve to normalize. And at ITR Economics, we think we're going to see that in 2024 for all the reasons that we just talked about. And we still expect to see one quarter 2024 weakness in GDP. So it's a question of when they're going to start it, from our opinion, but we think we'll get that 100 bips in 2024. We wanted to see it happening sooner, the onset of decline. It would have been great for the first goings of 2025 if it had. But at least we're at a position where the yaw is the gap is coverable with just normal Federal Reserve behavior. So here's hoping to normal behavior in 2024. So it's good news, bad news, right? Inflation is coming down, but we have manufacturing that's in negative territory. We have overall industrial production that's in negative territory, and GDP clearly is slowing down in the fourth quarter of this year compared to the third quarter. What do you have to be thankful for? Still looks like a mild downturn from our perspective when we look at all the factors. And mild downturn means that you can power your way through it with the right tactics and the right strategies. Watch your cash flow carefully, get your inventories down, stay lean and mean in 2024 with an eye toward taking market share from anybody you can. We'll see you on the other side of Thanksgiving. You take care of yourself and have a happy Thanksgiving.